When you think about banks, you probably picture a place like this. A building with tellers, ATMs, and maybe that stale cup of coffee sitting in the lobby. That's where the money lives, right? Most people think banks are the center of the financial system, and for everyday banking, they are. But what if I told you there is another financial system that's even larger than the traditional banking system, and most people have never heard of it? Depending on how it's measured, this system is connected to well over 200 trillion in financial assets worldwide, yet most people couldn't even tell you what it's called. It sounds like something out of a spy movie. Shadow banking. And no, before you ask, it's not a bunch of bankers meeting in a cave wearing black hoodies. Sorry, I know. I was disappointed too. But the truth is actually much stranger. Shadow banking is completely legal. It's a huge part of modern finance, and chances are you've benefited from it without ever realizing it. Which raises the obvious question, if it's so important, why doesn't anyone talk about it? By the end of this video, you'll understand what shadow banking is, why it exists, and how it helped shape modern finance, and why regulators around the world keep such a close eye on it. Let's get to it. So, what exactly is shadow banking? The name may sound mysterious, maybe even illegal, but that's actually one of the biggest misconceptions. Shadow banking is not illegal, it's not a secret club of billionaires, and it definitely isn't a second government printing money in someone's basement. The internet can be a weird place. The word shadow simply means these businesses perform some of the same jobs as banks, but without being a traditional bank. To understand that, let's first look at what a normal bank actually does. Imagine you get paid on Friday. You deposit your paycheck into your checking account. The bank doesn't just lock your money in a giant vault forever. If it did, banks wouldn't make much money. Instead, banks use customer deposits to help make loans to other people and businesses, while keeping reserves and following regulations designed to protect the banking system. That's one of the main jobs of a bank, connecting people who have money with people who need to borrow money. Now here's where things get interesting. What if another company started doing something similar, but instead of using everyday checking accounts, it raised money from investors or borrowed in financial markets? That's the basic idea between many parts of shadow banking. Money still moves from people with cash to people who need it. It just takes a different route. Think of it like getting across town. You can take the city bus, you can call an Uber. Different systems, same goal. One gets you there using public routes, the other takes a much more direct route. Traditional banks and shadow banking often solve similar financial problems, but they do it in different ways and under different rules. Shadow banking is not one company, it's a whole collection of different businesses and markets. Some lend money directly to companies, some finance cars, some buy short-term debt, others help financial markets keep money moving from one day to the next. Think of it like a toolbox. Every tool has a different job. Calling all of them shadow banks is a little like calling every tool in your garage a hammer. They all belong to the same toolbox, but they do very different things. So if these companies aren't taking your paycheck deposits, where does all the money come from? And why did this entire system grow so much that it's now connected to hundreds of trillions of dollars in financial assets? The answer starts with one of the biggest financial disasters in modern history, the 2008 financial crisis. Shadow banking did not appear overnight. Parts of it have existed for decades, but to understand why it's so important today, we need to talk about 2008. By now, almost everybody has heard of the 2008 financial crisis. Millions of people lost their jobs, home prices crashed, banks failed, and governments around the world stepped in to stop the financial system from completely freezing up. You can think of it like a waiter carrying way too many plates. Everything looks fine until one slips. Then suddenly, everything is hitting the floor. After the crisis, governments introduced new rules to make banks more resilient. Banks could still lend money, but they generally had to be much more careful about how much risk they took and how much capital they held. Imagine your parents catch your older brother crashing the family car. The next time you ask to borrow it, suddenly there's a lot more rules. Banks weren't grounded, they just had stricter expectations. But here's the thing, businesses didn't suddenly stop needing money. Companies still wanted to expand, build factories, buy competitors, and hire workers. So if banks became more selective, who stepped in? That's where many non-bank lenders grew rapidly. They weren't replacing banks entirely, they were helping finance parts of the economy that investors believed could earn higher returns. Instead of relying on everyday checking accounts, many of these firms raised money from pension funds, insurance companies, university endowments, and other large investors. Think about that just for a second. Your retirement savings may never be loaned directly to a company, but they could be invested in a fund that does exactly that. Wait, retirement money? Yep. Not because anyone is doing something shady, but because large investors are always looking for ways to grow their money over the long term. The financial system became more diverse. Instead of almost everything flowing through banks, money now moved through many different channels. Think of the financial system like a city's plumbing. If all the water flowed through one giant pipe, that pipe would become a problem if it burst. So over time, new pipes were added to move water in different directions. That's one of the benefits of having multiple sources of financing. If one lender pulls back, another might still be able to provide funding. But there's also a downside. The more pipes you build, the harder it becomes to see how everything is connected. And that's exactly what regulators spend so much time studying today. Not because every part of shadow banking is dangerous, but because the connections between different parts of the financial system can become incredibly complicated. Which brings us to the biggest question of all. If shadow banking helps the economy, how can it also make financial crises worse? That's where things start getting really interesting. So here's the million-dollar question. If shadow banking helps businesses borrow money and gives investors more ways to invest, why do regulators spend so much time worrying about it? Because something can be incredibly useful and still create risks if it grows too quickly or becomes too interconnected. Cars are useful, electricity's useful, the internet's useful, you still don't want any of them catching fire. That's a problem for future you. Don't actually do that. Most financial problems in shadow banking come back to three simple ideas: borrowing, connections, and confidence. Let's start with borrowing. Borrowing is not bad. In fact, it's how businesses grow. They borrow money to help build factories, hire employees, and develop new products. But if you borrow too much, even a small problem can become a really big one. Imagine carrying a backpack. One textbook, not a problem. 20 textbooks, your knees are filing a complaint. That's a simplified way to think about leverage, using borrowed money to increase potential gains while also increasing potential losses. Next comes connections. Modern finance is not made up of isolated companies, it's a network. Banks lend to funds, funds invest in businesses, pension funds invest in those funds, insurance companies do too. Everyone is connected in different ways. Imagine a neighborhood where every house shares electrical wiring. If one house loses power, it might not be a big deal, but if the wiring is connected in just the wrong way, suddenly the whole block is in the dark. And finally, confidence. This one surprises people. Finance runs on trust. If people believe they'll get their money back, markets usually function normally. But if enough people suddenly lose confidence, they may all try to sell assets or pull their money at the same time. It's like announcing free pizza in an office with one tiny door. Everyone tries to leave at once. Nobody gets through it very quickly though. Somewhere, there's always one guy who took the last slice. When many investors try to sell at the same time, prices can fall quickly. Falling prices can create pressure on other investors who may also decide, or be forced, to sell. That's one way financial stress can spread. That doesn't mean every period of market stress becomes a financial crisis. Most don't. But it's one reason regulators pay close attention to areas where borrowing, interconnectedness, and confidence all meet. So has this ever actually happened? Or is this all just a bunch of economists worrying about hypothetical problems? The answer is yes. And one of the biggest examples changed the financial system forever. To understand why regulators pay attention to shadow banking, we have to go back to one of the biggest financial events of the modern era, the 2008 financial crisis. Before the crisis, millions of mortgages were being made across the United States. Many people were buying homes, and for years it looked like housing prices would continue going up forever. But eventually, reality caught up. Some borrowers struggled to make their payments, housing prices started falling, and a problem that began in the housing market spread throughout the entire financial system. One important piece of the puzzle was something called securitization. Instead of a bank holding thousands of individual mortgages, many loans were bundled together into financial products that could be sold to investors. The idea itself wasn't automatically bad. Spreading risk can be useful. The problem was that many people underestimated how risky some of these loans actually were. Some financial products became extremely complicated. Investors, rating agencies, and institutions didn't always fully understand the risks hiding inside of them. And remember our earlier point about connections? This is where that mattered. Problems in one area of the system started affecting other areas because so many institutions were connected through loans, securities, and short-term financing. Another important piece was short-term funding. Some financial institutions relied on borrowing money for very short periods to finance long-term investments. This works fine when everyone trusts the system, but during a crisis, lenders can suddenly say, "Wait, I'm not comfortable lending anymore." And when that happens across a financial system, things can move very quickly. The lesson from 2008 wasn't simply, banks are bad, or shadow banking is bad. The lesson was that complicated financial systems can create risks that aren't always obvious until stress hits. When you combine high borrowing, complicated products, and a loss of confidence, small problems can become much larger. Today, regulators aren't looking at shadow banking because they think every non-bank lender is dangerous. Many parts of the system serve important purposes. The concern is understanding where risks are building and how many different parts of finance connect to each other. Because the biggest question isn't whether the financial system will ever face stress again. It will. The real question is, where will the pressure show up next? And one place regulators have been watching closely is a market most people have never heard of, the repo market. So after all of this, you might be asking yourself, okay, but how does this actually affect me? I don't work on Wall Street, I don't manage a hedge fund, I just have a bank account and pay my bills. And that's exactly why this topic is important, because modern finance affects almost everyone, even when we don't see it happening. Interest rates, business loans, mortgages, retirement investments, and even the cost of borrowing money can all be influenced by what happens in the broader financial system. You don't need to know every gear inside the machine to use it, but understanding that the machine exists helps explain why markets sometimes move in unexpected ways. Shadow banking is one of those hidden gears. It helps move money through the economy. It helps businesses get financing. It gives investors more options. Those are real benefits. But like any powerful system, it can create problems if risks build up and people don't fully understand where those risks are. The things to remember are simple. Debt can increase both opportunities and risks. Financial connections can spread problems, and confidence is what keeps markets running smoothly. You don't need a finance degree to understand this. Most financial concepts sound complicated because they're explained like they were designed to scare people away. Half the battle is just translating the fancy words. Leverage means borrowing. Liquidity means having access to cash. Securitization means grouping loans together and turning them into investments. Suddenly, finance becomes a lot less mysterious. And this is only one piece of the bigger financial puzzle. We've already looked at private credit, where non-bank lenders provide billions of dollars in loans to companies. Next, we'll break down the repo market, the overnight lending system that keeps huge parts of Wall Street running and has required emergency support from the Federal Reserve during periods of stress. And trust me, when you first hear how it works, your reaction will probably be, wait, they do what? Yes, they do. The financial system is complicated, but it doesn't have to be impossible to understand. The goal of this channel is to break down the biggest financial stories, explain how the system actually works, and make complicated topics simple. If you want to understand the hidden systems that move the world economy, subscribe, and I'll see you in the next one.